Ladies and gentlemen, it's 3 p.m. Eastern on a Friday afternoon, which means it's time for my favorite show, at least. I don't know about everyone out there, but it's my favorite show, Pirates of Finance. Welcome. Thank you for joining us. We're your hosts. I'm Corey Hoffstein, that devilishly handsome man to my right on screen. I don't know if this is mirrored. Is Jason Buck. We can't thank you enough for being here. If markets have been confusing you lately, this is the show to listen to. Not because we're going to provide any clarity, but at least you're in good company. So welcome. Thank you for joining us. Whether you're listening now or in the future, we appreciate your time. Jason, I'm a hot mess right now, but I want to come out swinging with like the biggest question on my mind. This one's a heater. When was the last time you had animal crackers?
Gotta be at least a decade for me.
I gotta tell you, I was hanging out with my nephew. Had myself an animal cracker or two. I don't know why I ever stopped. That might be the greatest snack ever invented, because they're not crackers. They are most certainly
vanilla
cookies.
wafers, right? Are they wafers or cookies?
They're definitely cookies. A vanilla wafer is a cookie too.
Yeah. Well, answer me this though: do you take a perverse sort of pleasure in biting the heads off?
I just go full animal.
There's
not enough time to go one at a time. This is like 6 animals in the mouth all at once. Yeah, it's
couple of things before we get started. One, and I'm noticing in the comment, I'm trying not to look at the comments, but people are already commenting on you not wearing your goggles. Second of all, as soon as we came on, I was like, it's sweater season. What's it feel like to be stateside and be cold again?
I gotta tell you, it's not even cold out. It's where I am. I'm outside of Boston right now. It's probably 65 degrees. I just living in the Caribbean for a year and a half has made my blood so thin that I'm just freezing cold. It'll be interesting to see if I ever get any robustness back.
So being a quant that prides himself on precise language, yet you just use my blood has become thin. That's one of my least favorite things that people try to say is like thin or thick blood for cold or heat. It's like, okay, it's a great euphemism.
I don't know what to tell you, man.
Yeah,
I've become a cold-blooded animal.
You know what I was thinking about though too is like you're prefacing this with like, if you don't understand markets, is my favorite comments are always is like, these guys didn't talk about anything for the first 8 to 10 minutes of substance, and I'm like, oh thanks, after 10 minutes we got to something of substance and value.
Well, that's why I came out swinging with animal crackers.
Yeah, the usual.
Listen, it's a filtering technique. This is how you figure out who your audience is. We plant our flag with animal crackers and see who sticks around.
It's was a DH in the comments says I'm eating frosted animal crackers currently. The serendipity
we found our tribe.
We found our tribe. Unbelievable.
There you go. There we go.
Right,
okay.
So
should we get?
Do you have any? I was about to say, do you have anything from your week before we bring in Jack to actually get us back on track? Or like I'm trying. Like this week's been a blur for me. I'm sure it's a blur for you with moving back and then everything going on in markets. And for everybody to know, like usually the turn of the month is always a fast-paced time for both of us. I assume for you too, right? Like just everything at the turn of the month seems to be chaotic, and you're trying to get out your monthly estimates and everything. But it's a little bit different for you because you're getting real time striking your NAV at all times. So I think it's a little bit different for private funds versus like
running public funds. You've got daily NAV being struck, but we still have clients who want end of month attribution analysis. And you just have to sit on your hands. There's nothing you can do till those final numbers come in. And a lot of times, even once those final numbers get marked, you need to wait the next day to get all the benchmark data you need to get posted to, index returns and that sort of stuff. So you're literally, there's nothing you can preemptively do. You can sort of try to write software to make your job easier, but in terms of writing the analysis, pushing it through compliance, getting feedback from compliance on anything that has to change, getting it finalized, getting it sent out. It's a 2 or 3 day process that you have to do at the end of every month. That is just, there's nothing you can do to speed it up, and there's nothing you can do to sort of like do it preemptively. It's the same with writing quarterly commentaries. There are parts of my commentary that I maybe try to pre-write, but anything related to numbers or attribution analysis, you just sort of have to wait.
Yeah, that might be shocking for people to hear, that like we don't get like perfect numbers right at the close on the last day of the month. That sometimes it takes at least 24 hours, if not longer, to reconcile all the trading positions, including options positions. And you would think in 2022 it wouldn't be that way. And I guess some would argue this is a good use case for blockchain, but I'm not sure that would solve across
people might be
multiple
surprised.
strategies.
Here's one for you, and I think we may have even spoken about this before, but like even on some of the most liquid instruments in the world, like S&P 500 index options, I will every once in a while get a call from my portfolio administrator saying, hey, we don't know what this option's valued at. Yeah. And by the way, all they do is they just, to strike NAV every night, they look at the number of shares we hold of everything. They go to Bloomberg, they find the Bloomberg closing price, and this is all done in a spreadsheet. They multiply and add, and then divide by the number of shares outstanding in the fund, and that's NAV every night. And so if Bloomberg doesn't post the price, they literally call me up as the advisor and say, hey, what is the price of this option? And so every once in a while, I got to go out and I got to go, okay, it's Bloomberg doesn't have a price. This thing hasn't traded. Is there any other market venue that's got a tight enough bid-ask spread that I think that's a reasonable price? I got to check another couple market venues. And you're literally going, that's the price.
Especially good luck if you're buying teenies too. Like now we're talking a whole different ball. Like the bid-ask spread can get so wide.
God forbid that happens at the end of a quarter or end of month. It's just, it makes the attribution analysis that much harder. So yeah, this stuff, these are the joys of portfolio management no one told me about before I got into it.
Exactly. Now let's, I guess, bring in the heat with Captain Jack. For those who don't follow Captain Jack's podcast, he's got quite the guest lineup. So he's crushing it these days. So maybe, we'll see how his questions are today, and if he's bringing the heat for this one.
I actually want to ask Jack about that. So Jack, you just interviewed I think Harley Bassman, and I think you're having Ben Eifert on, if I'm not mistaken, coming up.
Yeah, that's right, Corey. I want to say I'm not the only one here who's booked some heavy hitters. Corey, you just had an episode with the one and only Mike Green talking about passive investing, talking about the VIX, the whole XIV blow up back in the day. And Jason, you had a guest who's arguably like one of the biggest guests in the world.
Huge. Big get.
Yeah. Jason interviewed Corey Hoffstein on his podcast. And
Never heard of the guy.
Yeah. I just like the different types of music that we all have for our podcast. Corey, your podcast is really wholesome and catchy. Jason, your music is like very sophisticated.
The Pink Panther.
Yeah. And I also just want to say that, Corey, as soon as you mentioned animal crackers, I just could not stop thinking about Oreos. So I probably will be doing that for
That's another good one.
Jack, I know we're being facetious about me getting Corey on the pod, but I'm sure I want to get your take. Is like we did get Corey to speak about things he doesn't normally speak about publicly. So I'm almost hyping my own podcast here. So forgive me for my own personal shout out. No free shout outs. But it was an interesting, I think one of the more interesting podcasts Corey's ever done. So I highly recommend people go give it a listen if you want to actually learn about the man behind the gorgeous hair, beard, and eyes. It's Corey Hoffstein, about what he's gone through in his life. But Jack, what was your take on it?
I think you're right. I think that when you interview a guest, there's a range of how good they're going to be. Like you have like let's say a theoretical value before they do the interview, but then once you realize just like how good it is, and they have a range. And I think Corey gave a good interview. And I think it, I haven't listened to tons of other interviews where Corey's been a guest other than this current one, but he gave, it was interesting. So I was going to ask this later, but because we brought it up, you guys talked about being an entrepreneur, and Jason, I know you define yourself as an entrepreneur. You're very proud of that term. You really like that term a lot. Corey, you're a little more reticent to embrace that term. Jason, tell us why you like the term. Corey, why you don't think of yourself as an entrepreneur, and then I guess I have a lot of follow-up questions. But
well, I actually don't like the term.
Okay.
Like it's just like I mean, they're all nonsensical. Like the way the one thing I want to say is I think it's a bug, not a feature, to be an entrepreneur. And unfortunately, in the last few years, it's become highly exalted to be an entrepreneur. Everybody puts it on their Instagram bios and everything. But like, I think you're much better off, and you have much better brain chemicals, serotonin, dopamine, etc., if you know how to like take a paycheck, right? Like that's just an easy way to get addicted to a paycheck in life and to go through life. And I think there's something wrong with you if you're like, I want to go make a dent in the world, and I want to start this business, and I want to go 2 to 5 years without making any money, and I can really do something unique and go 0 to 1. I think that's really a bug, not a feature. And I don't think that it's anything necessarily to be proud of. It's that you can't really fit in with society and the way it's structured.
Yeah. Also, Jason, so you're not in love with the term. That's what I sort of wanted to hone in on, because I think that the word has become so exalted, so popular, so overused that now people may associate it with like the Shark Tank sort of hustle porn,
Yeah.
as well as perhaps sort of like the VC Silicon Valley bubble-ish thing where it's like, oh yeah, I'm the CEO of a juice company. We're valued at $12 billion. So I'm wondering, Corey, what do you make of it?
Well, before Corey, Corey's got a side. Before Corey comes on too, the other thing is like when people always ask me like, "What's your job title?" and stuff, it's always like laughable. Everybody has an important job title, but it's like mine's like janitor. It's like Corey knows. It's just like it's all hands on deck. You're gonna do 50 different jobs. Like there's no one job title. It's like wherever the fire is, you're gonna go try to put it out. I mean, that's what you do.
Yeah, I think for me, and I mentioned this in the podcast I did with Jason, my father started several businesses. He was a serial entrepreneur. I've had my one business, and I don't know whether that makes me an entrepreneur or not. I've been doing the same business for 14 years, and yeah, it's been reinvented a couple of times under the same banner. But I don't know. I don't think of myself as an entrepreneur. I think entrepreneurs tend to want to start businesses over and over and over again. And I sort of look at this, and I don't know what I would do without my business. And I don't know whether I would necessarily start another business. So I don't know. I think entrepreneurs are just a different breed, and I'm not sure I consider myself among them.
Well, another part of it, and Corey knows this really well, is like I think like if like everybody always asks like where do you come up with good business ideas, and it makes me laugh, and that's how I know maybe you're not an entrepreneur. It's like I have like five business ideas a day, and it's about saying no to those ideas. And Corey knows because I text him all these random ideas every day. What about this? What about this? What about this? And so it's like your mind. I'm
very good at saying no to them.
Yeah, you're very good at it. I'm not so good. You know, hopefully I don't have shiny object syndrome. You always got to worry about that. But that's where I kind of like know whether you're born and bred for this or not, is like how many of those ideas are you having on a daily basis? And like, can you really vet those ideas, say no to those ideas? Because what you're really doing is like, you're a malcontent, right? You're just like everything you see in life is wrong. And you're like, that should be done better. And I could figure out a way to do it better. And so it's actually a terrible way to go through life, because all you're doing is you're pissed off all the time. And eventually you get so pissed off, you're like, I'm finally going to do something about this.
To what degree can you attribute sort of the rise of the phrase entrepreneur to low interest rates and sort of a certain speculation in growth companies? Or I was thinking this earlier, everyone always wants to blame the Fed and low interest rates for Silicon Valley excess, but rates are, not super low in 1995 through 2000. So to what degree are they independent of each other?
It's exactly the opposite. If I actually look at the data, like company formation entrepreneurship's at all-time low. So even though we're exalting all these stories coming out of Silicon Valley, the average American is actually not starting a business. It's at the lowest rates like it's ever been. I mean, we had a lot more company formation entrepreneurs coming out of World War II. I mean, there's other exogenous events of why that took place and what the opportunities were versus the risks. But maybe Corey has a different take on that.
Yeah, I mean, I think we've really conflated the term entrepreneur necessarily being within the tech industry, because that's really where a lot of the headlines have come from. You can be an entrepreneur without ever going near tech. But I think you saw this huge boom because there was a glut of liquidity, but also because it was enabled, right? So my father, for example, who was an entrepreneur in the tech industry, took his last company public in the .com era. When you wanted to start a tech business, first of all, VCs were a lot more skeptical, but you had to buy a ton of physical hardware and host servers in a building. You didn't by 2010, you had Amazon Cloud. And so the costs of getting started were a lot easier. You could be a quote unquote ramen entrepreneur working out of your basement and controlling hundreds of Amazon servers that were all being remotely managed by a professional service. And so the amount of money you needed to raise was a lot lower than you historically needed to. So I think a lot of the technology infrastructure that was built in the .com era, roll forward 10 years, became a lot more cost efficient and accessible and enabled a different type of low cost entrepreneurship.
Yeah, I think the I always talk about like the bricks and mortars, your historical entrepreneurship. And so you needed a lot of capital to really get going. The CapEx was really expensive to get started. So now with all the technology, it makes it easier, but at the same time, that's easier for everybody else. So the competition just is high. Like it's always a Red Queen principle effect. It's like, it's always hard no matter what you do, no matter what the technology is, it's always going to be a difficult business to be in.
All right, let's go to my next question, which is, what do you think the correlation is between inflation and 26-year-olds who say that they have a fund?
Man, you are really setting us up today. So, all right. So I forget, we get like 7 minutes on the clock. So I think what Jack's referencing is it does seem like everybody has an angel investing VC fund. And so I'm not going to hate on anybody for going for it. That's the other part of being an entrepreneur. Even if I disagree with somebody's businesses, I respect the rolling of the dice, the effort. Like you got to respect the effort. But there is, I don't know about the correlation with inflation, or even previously Jack was talking about like interest rates. Who knows what the correlation is? I just think this is more generally, whether it's a bubble in tech or social media, it is interesting how everybody with some form of social media presence can start an angel VC. And I mean, that really started actually to me in my mind with the angel list, how it was really easy to spin up syndicates on angel list. And when it originally started, that was a phenomenal idea. I remember looking at that, over a decade ago and being like, wait, I can get into the deal flow of some of the Silicon Valley insiders and just pay them, what was it, 1 in 20, I think, or maybe it was just 25% carry on the back end. But that at the time, it was always the hardest to get deal flow. So if somebody built up a reputation over a decade in Silicon Valley, and then you could access their deal flow for paying them a percentage of carry on the back end, that was brilliant when AngelList first started. But then I do wonder now if like it becomes so much easier to spin up a syndicate or all of these rolling funds, and then just put that really in your Twitter or your Instagram profile. I'm not sure what that says. And is it a bubble, or are we just seeing it in clocking it more often? I'm not sure.
So I have two quick thoughts. The first is that the number one rule in show business is you don't drink a glass of milk right before recording. And I have poured myself the biggest latte. And anyone who watches this show knows I drink a lot during the show, and I'm immediately regretting it. We're 20 minutes in, and I'm not going to make it.
Milk was a bad choice.
Milk was a bad choice. You are spot on, in my opinion, with AngelList. When you think of what the moats are when it comes to running a fund, if you got rid of AngelList, the number of people that would be able to run a syndicate or be able to access someone else's fund would drop dramatically. Just the number of funds would drop dramatically. I do think that there would still be a large number of angels. Money chases returns. You saw tech entrepreneurs hit it out of the park in the early 2010s, excuse me. And I think that invited a lot of people who had suddenly made a lot of money at Google and other hot startups in the mid 2000s to turn around and reinvest in the ecosystem. So I think there still would have been angel investors, but I'm not sure when you talk about all the due diligence that needs to be done in the deal flow, am I just following on in a syndicate? It's not quite as easy. And I do think AngelList made it infinitely easier to do a lot of that. I saw a Twitter post the other day. It was someone said, if you're making $200,000 a year, you should be angel investing. And I'm not sure I could agree with that any less. Angel investing is like literally the most speculative form of investing. And unless you really know what you're doing and you're willing to be very patient with the deals and you have good deal flow, right? So you have to consider like the adverse nature. Why are you seeing these deals? And then you have to consider the market timing. What happens if you invest in a company in January 2020 and they're out of business by March 2020? Where are you in the market cycle? So this is something you got to do over a full market cycle, right? So you're spreading your cash out over 10 years. So you're really dedicated to this in your portfolio, and you really think you're going to see good deal flow the entire time. And you're an expert enough to try to figure out what deals are good or bad, which I'm not even sure is possible, honestly, given the deals I've seen. I'm not sure it's the best use of a person's time, honestly.
Yeah, I think, well, unless you had like a really narrow niche that you were going after, possibly, and you were an expert in that niche, but you just it said several things that always concerned me. One is adverse selection. So who are you? Why do you think you're actually getting decent deal flow? You're likely not. So you have adverse selection bias. The second is that, what are you doing for due diligence? And what I see these days is like, oh, A16Z invested, so now I'm going to invest alongside them, so I'm not going to do any due diligence. They must have done due diligence. And then the third is the spray and pray. I just love always asking VACs, like, are you spraying and praying? And just to listen to the excuses they come up with. And I don't think that's pejorative.
By the way, I've told you I invested in a fund back in 2012,
Oh, yeah,
2013. That was
They were spray and
explicitly
pray,
a
yeah.
spray and pray. 500 startups was a seed and series A spray and pray strategy. Global technology companies spray and pray. They basically said, we have no ability to predict which of these companies is actually going to outperform. We think we get good deal flow broadly. We're just going to give you a big, broad basket. And if I look at the stated returns, my money would have just done as well if I just bought the NASDAQ. And it would be 100% liquid in the NASDAQ. And for all the money I invested back in 2012, I have only seen a 50% return of my capital, despite all the on-paper gains I've seen. So you're talking about a decade with zero liquidity, huge markup. Who knows where it is this year? They haven't posted anything since Q3 2021. So as far as I'm concerned, I'm still up.
It makes me think of two other things. One is, like I always ask people real estate when they want to be part of real estate syndicates in different regions of the country where they don't live and they have no experience. I'm like, the first hurdle rate should be like, why am I not leveraging up the 10-year versus this trade? Can I assess the larger headache of a real estate deal, and do I get better value there? So like you were saying, the first question then should be on the VC side is like, am I doing better than investing in Qs or leveraging up the NASDAQ? So like, that should be the hurdle rate right there, right?
Yes.
Is that, sorry, you were going to say something.
No. I think you're spot on. It's that hurdle rate. And I think you have to consider, like, if you're saying I can go out and be an angel and pick good companies, well, do you have the equal edge in picking good public companies, picking good real estate deals? Like, why do you think you can do this in private companies? And by the way, there are probably some people who can and who have a real edge in a certain area. But just because you know a certain type of technology doesn't mean you necessarily know the right business model or you know the right people to execute on that business model. There's a tremendous amount of luck there. So I just think it is a hugely speculative asset class. I'm not saying it shouldn't be done. I think given that we went through a period where there was companies are coming to the market later, having some private investments is fine. I don't think the statement, if you make 200 grand a year, you have to be doing seed is appropriate.
Well, the one defense of that is like with syndicates and everything, you could have as little as like $500. So maybe that's what they're saying too, to get your beak wet and at least start to maybe learn about it. Almost like when people, buy a fraction of a Bitcoin, they at least start learning about cryptocurrencies. So maybe that's what they're trying to say. I don't know. I'm trying to be charitable. But the other piece I wanted to bring up was that, Jack referenced, you just did a podcast with Mike Green. And one of the things you guys talked about a lot on there and what Mike Green's good about is that, legislative effects or regulatory effects, or how that affects pushing people into 401ks, then not only that, turning 401ks into target date funds, and how by nudging people down, you make that what's the only choices. You have two choices, select wisely kind of thing. But what I think was interesting, we were talking about how AngelList made it really easy to put together syndicate funds or rolling funds, but even more than that, I really wonder about like the safe note, like making like a one pager that then you can invest in a company. Like we don't have that industry. We started this podcast talking about how nightmare is even just get the right numbers. We always talk about compliance and regulatory risk and like how much most of our day is taken up by that. But why has the VCs done so well of aggregating around like making life simpler with like a one-page safe note for investing? I mean, with commensurate risks there, but like we are still living the dark ages of like fax machines.
So just for people who don't know what a SAFE is, it stands for, I think it's Simple Agreement for Future Equity. And what a SAFE is supposed to do for an angel round or an early round investor is to say, we don't know what this company's worth. We're going to agree to this safe note that is going to convert into equity. And there's certain ways in which it can convert. So it could say, we're going to convert at the next round raise at equal that round's valuation, or it could be equal to that round, the minimum of that round in a cap level. So, if the company takes longer to raise, it could have some sort of timing trigger to it. There's all sorts of triggers that can be built into a safe. But the basic idea is if you start a new business and no one has any idea what it's worth, instead of banging your heads trying to find a valuation, you use this safe note that became very popular. I think it came out of Y Combinator, if I'm not mistaken. I might be wrong on that.
No, I think you're correct.
And it eased the ability for people to raise money. A really good friend of mine has a brilliant business he's been running. I've been talking to him. He's been trying to raise money, and he went the safe route. And I did actually do a bit of angel investing with him. I think it's a good opportunity. Who knows? I also consider the money gone forever. But, for him, he was asking me, how do I come up with a valuation? And I said, you don't. You just do a safe. Right? Don't bother. Don't even try that. It's going to be too expensive. You don't want to fight with your investors about what the appropriate valuation is. You just want to get the money in the door. So do a safe. And I think you're spot on. By the way, we've gone way over 7 minutes on this topic.
Well, but I want to hit it before Jack says, though, for those new to the show, with Jack using the correlation, he's really just trying to poke at Corey and I, because we're not correlation guys. We're more spurious correlation guys. And then, by the way, I did remember, though, I want to shout out because I saw Menahem in the comments again. And like an idiot, I've been calling him Menachem, because I've never actually had to pronounce Menahem. I remember when I was younger reading about like Menahem Begin, and I was just looking it up the other day. So I've been mispronouncing the whole time. So my bad. And Jack, what's the next question that you're just going to try to annoy us with?
Well, I actually want to do a follow-up question, which is to me, it seems like the companies that have gone public from the angel lists and VCs, they have just performed so poorly over the past 2 years. And to me, it's coming to the point where I've seen, so few of them have done well and so many of them have done poorly, where, I see a SPAC and I see a Goldman Sachs note saying, oh, this stock, it's at $10, of course, the SPAC. This stock is compelling because it trades at 2029. It trades at 4 times 2029 adjusted EBITDA. And, I'm just like, this is not over, And I think I interviewed Peter Lynch's right-hand man, George Noble, and he puts it succinctly: game over. I'm on the game over narrative. Look, I know that I'm get excited by narratives. It's my job. I'm a podcaster. But what do you think of the whole game over narrative? That, like the $12 billion juice company, game over. What do you think?
You want to tackle that first, or I'm happy to jump in. It's like, one, I think the multiples have come way down, at least on the private side. That's what we're hearing from VCs. And then on the public side, that's tough, Jack, because I think like the hard part is like if you have 7 to 12 years for the liquidity event, typically with the IPO, you're bringing a company public into a broader macro environment that you might not be, a good environment for you. Right. And everybody is also trying to liquidate their position. So a lot of times we'll see this, everything in life has peaks, troughs. So you might see that and you might have to have a longer term time horizon on that. But like, I mean, do we go through ebullient times and then despair? Yeah. I mean, is this one of those times? Partially, I guess we'll see. I mean, you're seeing quite a bit of a tech wreck, but I don't see people really talking about it on the streets that much. These mean streets of Napa Valley.
I think you hit the nail on the head there, Jason. And I've got no data to back this up, but I would consider that a lot of these companies are going public much later in their life cycle than they have historically, which means there's less upside in theory. They've already hit a pretty big part of their growth curve, and the VCs have been locked in longer.
Yep.
And their mandate is not to be public equity holders, right? Their mandate is to get the liquidity and then recycle it back to their investors and then continue to make private investments. So when you consider that they don't want to be on for the ride necessarily with the public companies, and the public companies are going to market later with a lot more of the juice already squeezed out from a growth perspective, I think what you're finding is they're potentially just far less attractive when they hit the market. And then you get a bunch of depressive flow coming out of investors that have been locked up for the last 12 years. So I think it's, you had a lot of people especially with SPACs trying to take advantage of a market environment that ended up being potentially more short-lived than they thought. And then I think you just have, it's different than it used to be. It's just,
I was trying not to even bring it
is different than the late 90s.
And I was trying not to even bring up SPACs because, it's not necessarily the game, it's the controller on the game, right? So the people that are taking advantage of SPACs are making SPACs much worse than they need to be. So that's more of a different issue.
All right, Jack, hit us with the next one.
Yeah, to turn topics completely, the big sell-off in stocks as well as crypto is often attributed to the pretty vicious rise in interest rates that we've seen this year. But to what degree do the rise in interest rates change the value of options? And this goes to sort of the pun in our title, the Great Rotation. And also, does it sort of change the game? Where Corey, maybe you went to, you got your very complicated math degree in, let's say, 2012, and rates were zero then. Like, are you having to learn stuff now, or not? You knew it, but it's just you have to take things into account that you sort of didn't take into account. I guess rates went up, 2017 to 2019. But is this materially different? And like, does it change the way market makers do it? Should people be aware of this?
Yeah, Jack. So I'll take on the row side on options pricing. The other part about if rising interest rates affects is that's what crashing crypto. That's somebody else, not me. So this is, and I love the play on words, Jack. Actually, golf clap on the title. And I see even people asking in the comments, they didn't understand row. And this is the great part is like many options traders don't even understand row because, like you said, they haven't had to calculate row for forever. It's just been mark row as zero. And the idea is in, options Greeks and options pricing, row, RHO, the idea that is the percent move in option pricing with respect to 1% move in the risk-free rate. And so when you're talking about futures and options, usually have a carrying cost that's affected by the risk-free rate. And so that's why, I actually used to always ping over the last 5 years, a bunch of different options traders, just asking if there was a way to kind of isolate row. So if nobody's calculating row and they're setting it at zero, I'm like, what if in the next, what if you could buy leap options 7 to 10 years out and everybody's pricing row at zero and nothing happens except for interest rates rise? Could you isolate that so you have a convoluted trade on interest rates rising that you could get cheaply through options, especially on 7 to 10 year leaps? And almost everybody I pinged was they don't see how we could really work that out. Which I should have probably dug even more, but it was one of the things I've always kind of been always asking options traders is most of them have not really had to calculate row or is at least declining row on the call side, for most of their careers. So it is an interesting thing and part of options pricing that people have to take into account again is what is the risk-free rate? And then how does that risk-free rate affect my option prices via row, RHO?
Yeah, I'm not really sure it's that big an issue.
Yeah, it's not.
Excuse me.
It's not, though. That's the problem. Yeah.
That's the milk talking right there. I'm not really sure it's that big an issue. Most of this stuff is fully automated, right? So for people who are trying to manage their Greeks, and maybe they haven't thought about row in a while, but certainly the big market makers, this is stuff that they're aware of.
Yeah.
For individuals, yeah, they might have to start learning about it. But if they didn't learn about it over the last decade, just because rates are at 3% on the 10-year right now, or a little less than 3%, that's where it was in 2018, 2017. And if you were ignoring row back then, it's not like you suddenly need to know row now. So I'm not sure we're at a point where row matters yet, but it may matter in the future. You get up towards a 10-year of 5%. I think you start to see row having more impact, particularly if rates remain volatile up at 5%. Then you could have some impact. You're talking, I think it's been a while since I've actually looked at row sensitivity, but my suspicion is row is much higher in further dated options because you're talking about, discounting that future strike value back. That's really where it comes up in put call parity and option pricing. So, if all of a sudden you have a future strike and you have a significant change in the risk-free rate, the net present value of that future strike can change dramatically. But again, you need the initial condition of what the risk-free rate is to be high enough to actually have a meaningful discount. And then you need the change to be high enough. So,
right.
Yeah,
that's what I was saying too.
Matters, but
if you were buying in 2019 and you were able to get access to 10-year leaps, then you might have been able to make a trade based on row. But talking to Jerry Hayworth and everything, they're you're not going to likely make that much. It's not as much of an isolation trade as one would hope.
Yeah, and I think most people who are probably playing in the 1 week to 12-month period, most people I talk to, it's not that big an issue for where we are today.
Okay, so correct me if I'm wrong, but when interest rates are at zero, row exposure, row risk is still positive. it's not that rho increases as interest rates rise. It's just that you realize the loss and or gain. You realize it. So rho itself, the exposure itself, does not materially. I mean, it does, but it does not materially change. So now that interest rates are at 80 basis points instead of 0 basis points, it's not as if rho is bigger. It's just that the market has shown that interest rates actually can rise. So the prospect of future rises will impact the price of options.
Man, it's been a long time since I've done rho. I think rho. I got to think about this.
I was trying to follow what Jack was saying, but like Jack, the way I think about it and everything is everything has term structure. So especially if you come from commodity future space, it's like your cost to carry always has to be factored in. So that's the interest rates in rho are affecting your cost to carry of maintaining that position depending on what's the future length of your tenor. Is that what you were saying? Or I was just trying to understand what you were asking more than anything else.
I was saying that like I don't think rho itself increases materially as you go up. It's just that you lose money if you're short a call, or lose money if you're long a put. I think. If interest rates rise,
rho is positive for calls and negative for puts, and I believe rho goes up as the stock price goes up through the strike. I believe, but it's been a while since I've looked.
So yeah, I mean, Corey and Jason, you guys are extremely well informed on options, and Corey, you're like a very quantitative person. So I think the fact that it's been a while since you looked, that's kind of my point. That
you've been able to ignore rho for a very long time.
Yeah.
Well, like Corey said, but just factor that into your models as it rises and falls anyway. So like he's saying, even if you've just been artificially zeroing it out, it makes change on that initial move, especially the longer tenors. But like he's saying, if you're doing weekly, monthly, quarterly option rolling, it's not going to affect. Like it's just going to be commensurate with everything else, and the other Greeks matter much more dramatically than rho does. Is that fair, Corey? A reassessment of what you said?
Yeah, I think that's right on. Like it's on the order of impact. Rho is way lower than Vega and Gamma right now, and Delta.
Yeah, I know in Jared Dillion's book, he talks about how he was working as a NASDAQ and SPY trader, S&P 500 futures trader. He wanted to express a Eurodollar view, an interest rate view, but he wasn't allowed to. So he just traded S&P 500 options in a way to get exposure to the rho to get interest rate exposure.
So he was doing, so that's what I was wondering. I talked about buying 10-year leaps and trying to isolate it, but there's probably a much better way to play that trade. I'm not sure.
Let's see. Okay, so if it's not rho, if rho is not that big of a deal, what else is in play in the options market? I mean, in what way is this? This is a super open-ended question, but in what way is the options market now different than a year ago? I think volumes are down, like especially retail call volumes are down. Maybe realized volatility for earnings is up. I don't know. Like, what are you guys seeing?
Well, at least this is more recent. One of the things I've noticed, Jason, and I'd be interested if you're seeing this as well, is it really feels like that put skew that was really high, at least skew relative to calls, has come way down. What I'm seeing from the bank desks, from their notes and their data, is that a lot of the fundamental hedge funds that have degrossed their books, so their leverage has come way down, their notional exposure has come way down, have replaced their long equity exposure with call options on individual names, because they basically, their risk right now is failing to participate if the market bounces meaningfully, and so they've replaced a lot of that sort of delta 1 exposure with call option exposure, so they're not naked to the upside move. So what I've seen, at least, is it felt like a month ago put skew was really steep. It seems like that has come down today, and you're starting to see call skew pick up as people are pricing in potential risk to the upside, which I think we've talked about what that means before, right? But basically the risk is you don't have enough equity exposure and the market explodes upwards and you get left behind. People are trying to hedge that risk by buying calls because a lot of them are underweight equities right now.
No, I think we're seeing a lot of the same things. I think we've talked about it many times, I think, on this show. And I was talking about being at the EQ Derivatives conference the week before. And, people just talking about this being a fairly organized sell-off, or not like a lot of fear entering the markets. And a lot of people were saying that's because of, oversupply of volatility and hedging. But like, that's also sometimes hard to prove in general. Almost like it's just as difficult to aggregate all the dealer flows. So I wonder, I was actually talking to Devin Anderson from Convexitas earlier about this. Is like, what if people that, this organized sell-off is just because as stimmy checks rolled off and everything, people just stopped buying. And it can be that simple. And that's why you see organized sell-off and you're not seeing a pickup in, like skew is flattening, or like you're not seeing a payout in fixed strike vol on the put side, is because it's not necessarily because of an oversupply of vol. It's just people stop buying from over the last year and a half. And so who knows? I don't know the answer to that, but like I think Corey's right about what investment banks are saying. And then I brought up before, the insurance companies were interesting at EQD because they were talking about how they're not necessarily looking as much to Vega, both on the short and long side, as much as they're looking at just rotations and factors and dealing with just their linear instruments with stocks and bonds to manage a portfolio versus using derivatives.
I know Jem Carson has been talking about this a lot, sort of as part of his big macro themes for 2022, which is that, and a lot of people have commented on this, and you have as well, Jason, that after a crisis like 2008 or March 2020, people bid protection. And so it's very hard for the market to sell off. So you get a steeper skew in the options surface. Puts are bid up relative to calls. People have protection, and it's just harder for the market to sell off because those people become natural buyers of the market via their protection. And they're also not forced liquidators anymore, or they don't get forced liquidated because they have that protection. Jem's view is that it will, for the market to sell off dramatically, people will have to basically give up on buying protection. And so it's interesting that we're starting to see what seems like a bid for puts start to decline. I don't know if it's as low as Jem would say it needs to be for there to be sort of a more waterfall sell-off, right? But what you tend to see after 2008 is actually selling vol is the high probability, high payoff trade, not buying downside vol. And you need to wait till people sort of feel like, we burnt a lot of premium for no protection. And you're seeing it this year. A lot of people are buying downside protection, and that downside protection really isn't kicking in when VIX is spiking to 30 or 40. They're just barely starting to scratch profitability, and then the market bounces as people monetize. Seems like on this most recent dip, people didn't reload their protection, which could be the potential then for the market to sell off further.
Yeah, that's a good part of it. And then also, just because on the last episode, without his proper amount of caffeine running through his system, Corey was doing his best to explain fixed strike ball versus floating strike ball with the VIX. And I just want to give a shout out. I gotta give a shout out to Key Pagan Rush, KeyPaganRush on Twitter, who does these unbelievable videos on volatility if you've never seen them. But also, he did a nice breakdown with charts trying to explain fixed strike vol on Twitter. So give at Key Pagan Rush a nice follow on Twitter, because like he does a great job of simplifying and then illuminating through both charts and videos how volatility works, and especially flows in general if you watch any of his YouTube videos. So
yeah, huge credit to that person. I actually didn't know he did videos, so I'll watch those, especially in preparation for my interview with Ben Eifert. And I feel like I finally understand. And I also had a friend who works as a market maker. We had a dinner and drinks and just long chat, and he was just drawing diagrams. Like, I feel like I finally understand why the VIX is higher than implied volatility. Like, I first learned that it was, Corey, probably by listening to your podcast with Ben Eifert, 18 months ago. But I feel like, and it's just a process of being exposed to that fact and learning why, maybe 10 times. And I feel like now I finally get it, but I probably don't finally get it. Okay, my question is, Corey, you said, and Jason, you've said earlier, a hedged market doesn't crash because, as you just said, Corey, people exercise their puts or they use their puts and they buy back the market, and it's generated cash. But what about the dealers who are short gamma and they're short puts? I'm short Netflix. As Netflix sells off, I have to short a ton more Netflix, right? Yep,
they do have to short a ton more Netflix, and then what happens is the person on the other side of that trade monetizes the put, and the dealer has to buy it all back. right? So the way I always think about this is, because people get very confused which side the dealer is on. And the reality is, I always think of it as, if you're buying a put, yeah, there's a long vol position, but what you're effectively saying is, I want to make more money as the stock goes down. I want to be short without being short. And so you're just passing that on to the dealer, right? And so when you monetize that option, you are effectively enforcing buying back all those shorts. So one of the things we see is, like, there's a lot of people who don't like short selling, right? You hear short selling is un-American, it's anti-business. Short sellers are very good for the market, in part because they help stabilize the market. Short sellers are people who make a profit during a market decline and therefore become natural buyers of the market when they buy back their shorts. That is a stabilizing part of markets, right? So when we see short sellers disappear, well, that's one less natural buyer in the market. When we see people no longer buying put options, that's one less natural buyer when the market sells off. So that sort of activity is actually good for stabilizing on the downside, and is part of why, you know, a hedged market doesn't sell off as easily, because all of those people are going to be buying on the way down. When we don't have a lot of short sellers, when we don't have a lot of people buying put protection, you lose those natural buyers. And so then the question is, who's coming up with fresh capital to step in and buy during a decline?
And then I think, to answer Jack's questions, when the dealer positioning is positive gamma, it creates these mean reversion effects to markets, like Corey's saying. When it's properly hedged and everything, and the dealers are on the opposite side, you know, mean reversion affects environment of buying the dips and selling the rips. So that's why we tend to see those market dynamics, and that's why a lot of people are trying to point out dealer flows over the last 2 years.
So Menishem in the comments says he doesn't think I'm correct for shorting via puts because delta increases. That's not wrong, Menishem. But it's basically, what I'm saying is, if I'm buying a put, I am forcing the dealer to short, right? The expression I'm saying is, I want to make money when the stock or index goes down. And so that expression would be effectively being short. You are correct that it will be increasing the amount of short as the market sells off. The delta will go up, and therefore the dealer will have to short more and more. But when I monetize that put, right, that is going to force the dealer to unwind that short and buy back all that stock. And so basically, right, you can think of me as just, you could, in theory, replicate that payoff through delta hedging. I don't have to buy the put. If I could trade instantaneously with perfect liquidity and no transaction costs, I could delta replicate that put and do that shorting myself. It's just, I'm making the dealer do it, and I'm paying a premium for that. And then when I buy back, when I want to close my position, the dealer has to buy back all that underlying, and is effectively helping buy stock in a declining market. And so again, it's hard for market. We say it's hard for markets to sell off when they're hedged, when there's a lot of shorting, because those are people who are making a profit and want to lock in that profit, and locking in that profit requires buying back stock.
Great. All right, Corey, you were an early sleuth on the inflows into ARKK, that ETF, back in 2021. Are funds still flowing into ARKK? I know something like 2 months ago they still were. So are funds still flowing into ARKK? And would outflows cause a reflexive loop of forced selling that would sort of be a reverse of what we saw in late 2020 and early 2021?
Hold that. First of all, Jack, if you're going to come up with a question like that, you better come with the charts for the flows, because expecting Corey to come with that at the top of his head and having no prerequisite to know exactly what the flows are.
Jack, you're making me nervous. The person to follow here on Twitter on this, I think, is actually Eric Balchunas over at Bloomberg. He posts like once a week on ARK's flows, because I think they're still positive. Yeah. Again, this is one of those interesting aspects of prolonged bear markets, is that you get stubborn, unlevered longs and people who are buying the dip, right? And so again, that can help prevent markets from selling off. When you get people who continue to buy the dip, they're never forced out of their position because they're not levered. They never get a margin call. They're just long and believers in the faith of ARK. And so, yes, you have continued to see inflow into ARK through most of the year. I think the last numbers I saw were as of 2 weeks ago, that it was still continuing to come in. I can't really answer the second part of the question. So the analysis I had done it was back in early January 2021 it was for Pirates of Finance. You can go look up the episode, was recognizing that ARK, through both its ETFs, its sub-advised funds in Asia, as well as its separately managed accounts, owned a huge proportion of some of the underlying names, 20, 30, 40% of the names. And at least in my view, the analysis suggested that inflows into their strategies, which were being used to then buy the underlying names, were actually driving the price of the underlying names up, giving them good performance, inviting more inflows, and it became very pro-cyclical. We've since seen the bubble deflate, but I haven't actually looked to see whether they continue to be a significant owner of those names. I would suppose that unless they've clipped those names, they've actually gone up from 20 to 30 to more to 50 to 60, just because the price of those names has come down. But I'm not 100% sure whether they've continued to be buying the same names with all the inflow. So it's possible that their size has gone up, in which case, if we did see meaningful outflow, you could see pro-cyclical declines. But ARK is just one of those very curious cases of what happens in a weird bubble environment.
Yeah, and the risk is stating the obvious, which is all I do on this show, is that, it doesn't necessarily be inflows versus outflows. If people just stop inflows, stop buying, you can have a similar response that you'd have by forced selling. So that's just part of the equation as well. It's not just A or B.
Yeah. So Corey, what I just saw on screen, showed on screen, were the inflows from Eric. You saw that, right?
Yep.
Okay, cool. Now I've got something to share, which is that ARK ownership from Kathy's ARK website, and the most exposed, the stock that ARK owns, that ARK has the highest ownership percentage of, is 9.48%. So I can actually just share this.
Yeah, so I think that's way, way, way down from January 2021, where they owned 20, 30% of some of the names in their portfolio.
Yeah, I remember that too.
And Jack, that's not ownership, like that's ownership of the underlying market cap. That's not like percent in the ETF itself, just to be clear. And I don't know if you're trying to show something on screen, but
yes, it is. ARK ownership 9.48% for Beam.
Yeah.
And then remember,
so
all the funds, like she sub-advised out of Japan too. So like if you're also looking across ARK, you have to look at like all of the different fund usage that they're advising as well.
Yeah.
That we dug into before, if I recall correctly.
Yep, the separately managed account. So I was getting reporting on, Bloomberg reported on all this, and it did seem to be pretty pro-cyclical. But again, I haven't run the analysis in a long time, and it's not of huge interest to me. Again, if they bring their relative ownership down, that marginal price impact should go down for when they liquidate. So they might have used the last year to sort of clean up their relative ownership size. 9% is still a lot if they were to force sell. I mean, we saw what did Elon sell of Tesla a couple of weeks ago? I don't even remember what percent of Tesla he tried to sell, and it had a 10 to 13% price impact for his one-day liquidation. So if you saw a meaningful outflow of ARK, that price impact can be very real for some of these names, especially the small cap, less liquid stuff.
Corey, are you saying my net worth that of the stocks I hold is not real if I wanted to sell it in large size?
I might be saying that, but you could probably just take a loan against it.
Right. But that's what's crazy. Like if you think about that, is like to get an equity line of credit, like all you have to do is on the fictitious number of it, assuming we had a perfectly efficient market and you could liquidate your position today, and they'll give you a loan based on that amount. And some people would argue that's where some of the fragility is in the system, but I'm not sure how high, people's personal equity, line of credits are.
I was actually having a conversation. There's a retirement strategy for the equity wealthy that's basically like borrow, spend, die. It's called something like that, where you're taking a loan against your equity and then you're spending that money. And then when you die, there's actually like a step up in the cost basis of your securities, I believe, that are being lent against. It's like this interesting tax loophole I got to look more into. Hopefully there's maybe someone in the chat who knows more about this than I do. Not really relevant to me at this point in my life. And hopefully that loophole doesn't close in 30 years when I try to retire. But it's always interesting to see the ways in which people who have huge security ownership that are trying to avoid incurring those long-term capped gains use their securities as collateral for loans to try to create income.
Jack, you got any more heaters left in here?
We could end it if we want. I do have a question. It's not a fully formed question, but it's just what is the Federal Reserve, Jason's your favorite topic, when they hike rates, so much of the reason why it's supposed to decline stock price is because interest rates are higher, so the discount rate, blah, blah, blah. But I'm wondering, to what degree is margin debt just more expensive? So like, Eaton Vance or whatever it's called, like Morgan Stanley broker used to lend you at 6%, and now because rates have gone from 0 to 3%, now it's 9%. You know what I mean? And there are a lot of leverage in the market.
That's for those rates you're talking about, and then Corey and I don't know if we ever talked about this much publicly, is that those rates are for retail, right? If you go to Schwab and you want to take a portfolio loan on a Reg T account, they're going to charge you like 6 to 9%, or maybe even higher now. The whole point of like futures and options is we get like institutional quality loan rates, and you're paying, very little on that borrowing cost when you're trading in futures or options. Or quite frankly, if you have a larger account, you can go on like Interactive Brokers and they'll give you portfolio margin and they'll pass LIBOR or SOFR rates. Obviously it's adjusting, so you have to be careful of that. But the idea of what they charge retail for portfolio margin versus what they charge institutional are vastly different. So I'm not sure how much that is affecting the overall outcome, like you're asking, Jack.
Yeah, I mean, you can sort of think about like the very vanilla Finance 101 Gordon growth rate model, right? Where it's next year's dividends divided by your K minus G, K being your required rate of return minus G, which is growth. And I think the question is, so K is where you get that risk-free rate getting embedded. So as K goes up, assuming your future dividends and your growth don't change, the current price of the stock has to go down because your divisor is basically going up. But I think there is an interesting question of, okay, if this is a company that is using debt financing and rolling it, and that debt financing goes up and their earnings don't go up, well, that means next year's dividends actually have to go down. So now your numerator goes down. And how much of their debt financing going up prevents reinvestment, so their growth rate goes down, right? Which will also bring the divisor up. So the most obvious answer is yes, we have that aspect of discounted future cash flow that comes in with the risk-free rate. That is an obvious impact on stock prices. I think the less obvious impact is, how does the increase in the risk-free rate affect growth rates and affect the payout ratio that we would see with companies that would affect the actual end cash flow to investors? That's all sort of maybe more second order effects.
Corey, I've always wondered, here's a really dumb question. I get that's what the textbooks say, right? As far as like the discount rate and then future cash flows. But how much of that is based on like an old economy? Like if we're using, software or SaaS businesses that are, churning out, 20 to 30% margins, is that higher interest rate on their funding costs, and assuming they're even paying that higher rate, how much does it affect them versus like a classic value company that's maybe only churning out, 7 to 9% returns?
I think it all depends on the capital structure, right? I mean, at the end of the day, whether the company's paying dividends or not, there is free cash flow, right? That you are in theory entitled to. You can look at the equity as saying it's equal to the all future free cash flow, which, by the way, includes a terminal value of the business going out of business. Like it's not going to exist forever necessarily. And so you get that value of assets at the end of the day for that final payment. Or you can look at it as, right, a call option on the residual value of the business after all debt is paid. And there's multiple ways you can try to sort of square that circle in terms of recognizing what the appropriate fair value of the equity is. I would say it's probably relative to the cap structure. So energy companies tend to be more heavily financed than, say, technology companies. They also tend to have credit levels that are much lower. Like, your Disney or Google or Apple tend to be very highly, in highly valued investment grade credit, where a lot of energy companies tend to trade like high yield. So interest rates are potentially going to have a much bigger impact on those, longer duration, high yield type stuff. So it's a mix. Every business is different. It's hard to say what the actual impact necessarily will be across the board. But at the end of the day, we do know Finance 101, higher discount rates means future cash flow should be worth less, unless you get a weird scenario where higher rates somehow imply earnings go up. If someone wants to make that argument, have fun.
So I can't just throw a software filter on every company and just rank them, stack rank them. I actually have to do some research and figure out where their cash flow comes from and what their debt service is. Is that what you're telling me?
Yes. I do want to address one of the comments, by the way. I just saw here.
Yeah,
it's a really offhanded comment, but Legendary asks, why has IOFAX, a non-agency RMBS fund, collapsed and not rebounded compared to agency MBS, fixed products and credit spreads last week? Thoughts, prayers. So this is a company that also, this is a fund. It's the Alpha-Centric Income Fund. This is amazing. I know this, isn't it? I feel like Jim Cramer, who used to know every ticker.
You pulled this one right out of your ass, yeah.
Yeah. So this is the Alpha-Centric Income Fund. I know it as IOFIX. And it basically, my understanding is they've had a huge amount of redemptions and they're having liquidity issues. So they got crushed in March 2020. Also, we're dealing with some serious liquidity issues. My understanding is they're having really big redemptions, and that triggered a lot of forced selling of the portfolio, and it's having cascading effects in their portfolio. I believe they did a lot of less liquid trades. What is it called? It's risk transfer. Yeah, risk transfer trades, where they were buying stuff out of Fannie and Freddie, and I can't state any more than that. I do know I've got some good friends at Morningstar and their fixed income group that are looking into this right now, trying to get to the bottom of this story. So I'm sure you will see something coming out of Morningstar soon written about this fund.
That's all. The other thing at EQD is like it's so annoying how just all the acronyms are always changed. You know, it used to be like risk transfer service, and they're always just coming up with new ones because that's what the banks do, right? They wrap it in a new. But wait, it's different. Sorry, Corey, you have your hand up. What is it?
No, it's people are telling
you're
me
blocking the mirror.
They think it's a mirror. It's actually a fireplace.
Oh, there you go. That's
not a mirror.
I think are you just flexing? By the way,
but I've got so much alpha on my screen right now.
Yeah. Oh, you're trying to make sure you don't have anything there. Yeah, exactly. So my favorite comment today actually was from John Schmidt that I am definitely going to steal for future use. And he said, it's just plastic turtles all the way down. So the man after my own heart, I love turtles all the way down, but now plastic turtles, 10 times better.
I love it.
I also want to say to that question about the, first of all, Corey, yes, it is very remarkable that you knew that fund just sort of by heart. But I'll say it's not as if agency MBS funds are doing amazing. It's like they're also doing pretty poorly as well.
Yeah, this one in particular, though, is I think it's a liquidity issue where they had a very large client who I think had a $300 million redemption, and it just is causing some serious liquidity issues in the fund, which are then cascading because more people are trying to redeem as the fund. This is what happens with less liquid stuff.
Yeah, and it just goes to show that when you have a fund that people can redeem, you're just massively short optionality because anyone can just withdraw at any time, right? I mean, obviously you have rules.
Yep.
Yeah. Wait, guys, I don't know if I fully expressed my question, which is I get about the whole discount dividend model. That's theoretical. Largely what we see sometimes confirms that, sometimes it doesn't. But to what degree does the fact that if people are levered long equities, levered long risk assets, and their borrowing rate increases if what E-Trade gives them, does that actually force them to sell and cause asset prices to decline? And also, Jason, great point about institutional versus retail. If I'm paying SOFR plus 7 on my margin and you're paying SOFR plus 1 on your margin, actually SOFR rising will actually have more of an impact on you, right? Because I'm used to high rates.
It's an interesting way of thinking about it. So there's actually a study, a behavioral study, and I'm blanking on the name, and I should probably pull it up. But one of the questions, even before we get into the margin side of it, Jack, is how much equity versus bonds will people just hold as rates go up? And there was this really interesting study that was done, and again, take it with a grain of salt because it's a behavioral study, but basically tried to ask people a question, given different rates for bonds, different, risk-free rates, how much equity would they hold in their portfolio? And what they found was that it sort of hovered around the 40% level in equity, around 5%. And then as it went to 4, 3, 2, 1, 0, the curve exponentially went up. And when you got towards 0, people were basically holding 70, 80% equity. And so part of this might be simply behavioral. People are saying we can now hold less equity. We can sell equity off and try to buy more fixed income at 4 or 5% yields in investment grade credit or high yield, which wasn't available 2 years ago. And then the other side is there is a potential knock-on effect on the margin side. That one I don't have any good numbers on. I mean, you would presume that people would have to have higher earning opportunity because the hurdle rate has gone up, and that's not necessarily true. That it's not like you can't say rates go up and so the trading opportunity is now necessarily better, and it's just their cost of business has gone up. You'd have to believe that they would then either just accept lower profitability in their trades, or they might trade less because the opportunity cost has gone up. So I don't have any numbers there.
If I understand your question, Jack, I think it's, once again, as all questions, is like further nuance, right? Like what's the basket of investment somebody's holds, and what is their loan to value ratio? Like how much margin did they actually take out? Like, I think with portfolio margin, your max is like 6.6x, but they're also going to look across, they're going to run risk metrics across your portfolio. So you can't be just like in Google and levered up 6.6x times. They're going to want to see some diversification across that portfolio. But at the same time, if you were just running 50% Reg T margin and you were in tech stocks, you just got wrecked. So yeah, I think it's where is that attachment point where you have to sell because you're just automatically getting closed out, and that's going to be dependent on everybody's individualized portfolio. Is that your question? Go ahead.
Can I just add, because I just found it, if people want to see the graph I'm talking about, there's a fund company called Ruffer out of the UK. Ruffer Review 2022, Figure 5, behavioral convexity. And what they show is that at a 0% risk-free rate, people would hold about 70% equity. At a 5% risk-free rate, it goes down to like 57% equity. And a 10% risk-free rate, it's about 50% equity. So my numbers were a little off there, but the point is you get this sort of decline as risk-free rates go up, and people just sort of behaviorally would move away from equities into bonds, which would put, in theory, further depressive prices on equities from a flow perspective.
But like you were talking about too, the interesting thing is it's not continuous, right? It's almost like it like builds up and then all of a sudden it's a cascade. And by the way,
well, it is continuous. It is continuous from it's non-linear.
In the textbook, yeah, it's continuous, but that's the issue. And by the way, Ruffer,
look at Jack pulling that up
Jack
fast.
pulling up the quickness. But Corey, would you agree? Ruffer has some of the best writing in finance there is in investing. Ruffer, like if people don't know about Ruffer, the British firm, they're also known as 50 Cent. They were the ones buying the VIX calls. They have some typical like British wit and humor usually to their writing, and it's always it's a beautifully done website, and usually they write great essays.
Yeah, great writing. I will say I think they've got great returns as well as an absolute return fund. Speaking of 50 Cent, who in the world was buying the 100 strike VIX calls and selling the 150 strike VIX calls? They're like December calls.
Don't you think that's somebody just looking at risk getting repriced?
Maybe.
I mean, that's what the thing is. You don't have to worry about it getting through your strike. It's just the question is, when does fear reprice risk?
Yeah, but you do wonder when the strike is that far out. I'd have to think about what sort of move is required before that gets repriced meaningfully versus the liquidity that you have in a strike that far out. Mm-hmm. Right? Who are, when you go to unwind that, are how much are you going to have to cross the bid-ask spread, and how much of an impact are you going to have?
It's a fair question. I have no idea who's buying them. I guess we'll figure out. It would be interesting what the target avatar is going to be for that, like in the naming convention, right?
Yeah. Someone was saying it was 50 Cent, and
might be.
Insider knowledge tells me it's not. But who knows? It's always
dangling carrots right at the end of the show. I love it.
Right at the
insider
end.
Knowledge.
With that,
Corey, the consummate insider, Hoffstein.
That's right. Insider connections everywhere. Everyone, thank you for joining us. We really appreciate your time on a Friday afternoon. Hope you have a wonderful weekend. Again, this is Pirates of Finance on Blockworks. If you enjoyed the episode, give us a follow. If you're listening to the podcast later, make sure you subscribe. My name is Corey Hoffstein. You can find me on Twitter at @CHoffstein. That, again, I always point the wrong way. I'll get it right eventually. That devilishly handsome man right there next to me is Jason Buck. You can find him at Jason Mutiny. The man asking all the smart questions, running things behind the scenes, is Jack Farley. You can find him on Twitter at JackFarley96. We appreciate you. Thank you for joining us.
Thanks for the comments, everybody.